Welcome back. I'm so excited that you're joining us, and I see the room is rapidly filling up. Just like this morning, Jim has a lot to share in this afternoon session on post-election estate planning. So I would like to dive right in first, just with a quick audio and video check. So if you could do me a favor and navigate to the bottom of your screen where you see the chat, if you click on that, it should pop up on the right-hand side of your screen. If you can see and hear me clearly right now, if you could type a Y into the webinar chat, that would be great. Thank you, Janice and Wayne, Jim, Doug, Mike, Peg, Steve. Thank you so much. Ellen, it looks like everything is working audio visually, so thanks a lot. If anyone else would like to share where they're joining us from this afternoon, that would be wonderful. Earlier, Jim was saying this morning that he is joining us from Arizona, where the weather is quite wonderful. And he said that a lot of us here in Pittsburgh often complain when he complains about the weather, being 70, but a little cloudy. I would like to put a plug in for Pittsburgh today and say that it is 56 here today, so it's not so bad. Although I suspect that Jim in Miami is experiencing a little bit better weather. Hi, Wayne in Long Island. Thank you for sharing. Vic in New Jersey and Ben in Tulsa. I would like to go ahead and start just to give you we do have one more webinar today, so I'd like to give you the rest of the schedule because as most of you probably know, these are Zoom webinars, so you have to register for each one individually, and I don't think anyone is going to want to miss the third one today. So this webinar, which is post-election optimal estate planning for married IRA owners, will go from now until 2:30 p.m. Eastern, and then we'll have a brief break, and we'll come back at 3 p.m. Eastern for a really special program, special in two ways. One, because the first half of it will be the first time that Jim's newest program prior to these election programs, 7 costly retirement mistakes and how to avoid them, will actually be done via a live webinar. He did present these at our in-person events here in Pittsburgh in September, but obviously a lot of people were not able to attend those. So he'll be doing a portion of that program for the first hour. And then we have another last minute, but a really exciting surprise. Some of you may have attended our workshops before where Larry Swedrow, who is an investment and market expert, participated in some of our Q&As in past years, and he is back. He'll be taking post-election investment questions, although that's the primary focus. He really likes to answer any kind of market questions that you have. And I think that's going to be something that you really won't want to miss. So I've asked Eric to drop, and he probably will be doing it here soon, the link for the registration page for the 3 p.m. So that anyone who has not already registered can do that. And yes, someone has asked already about the resources that we provide as bonuses. We'll be giving those same links and all of that information in this webinar too, Fred. We'll just give it a little bit closer to the end. Lynn, I'll address your question about the hardcover book via chat, if that's all right. Okay, now I would like to roll straight into 2 things. One, Jim really loves questions, although we don't have as much time for them in these sessions as we hope. I am carrying questions over from the first session and this session to the third one. If you have a question at any point during the workshop, if you go ahead and click the Q&A feature at the bottom of your screen and you put your question into there, we will really try to take as many of them as we can. I know we have far more than we have time for, but please do enter your questions in there. If it were up to Jim, he would just be taking questions all day. And now I would just like to do a brief introduction and let him get started with his presentation. So Jim Lange, our presenter today, is a CPA and an estate attorney. He's also the author of 10 best-selling books that help protect the financial security of IRA and retirement plan owners and their families. He's been quoted in the Wall Street Journal 36 times. His books have been endorsed by some of the country's top experts, including Charles Schwab, the late Larry King, Jane Bryant Quinn, Roger Ibbotson, Ed Slott, Bob Keebler, Larry Kotlikoff, Paul Merriman, Larry Swedroe, and Burton Malkiel. His latest best-selling and highly acclaimed books include Retire Secure for Professors and TIAA Participants, digital and hardcover copies of which are available as bonuses, and we will be giving you all of the information you'll need to claim those a little bit later in the presentation, as well as Retire Secure for Parents of a Child with a Disability, and a digital copy of this book is also included in the digital bonuses for today's webinars. Jim is a nationally recognized IRA, Roth IRA, and 401k expert who's authored the first peer-reviewed article on Roth IRAs in 1998, which was published in the AICPA's journal, The Tax Advisor. His insights have also been featured in Newsweek, the New York Times, Forbes, Reader's Digest, Bottom Line, and Kiplinger's. He's a paid contributor to Forbes.com, and his peer-reviewed articles have appeared in Trust and Estates Magazine, Financial Planning, and the Journal of Retirement Planning. As a member of the team here at Lange, I've had a really unique opportunity to get a behind-the-scenes look at just how much he cares about presenting topically relevant and useful information in these workshops. And this afternoon session is no exception, and it's going to be an excellent resource for anyone who's in search of great information and cutting-edge retirement and estate planning strategies. So without further ado, please welcome Jim Lange.
Thanks, Erica. And to allow more questions, I'm going to try to cut out two portions of the program: no political talk and no story to start the workshop, which I like. And you're supposed to do stories, but I'm a content guy. I have a lot of content. I want to take more questions than I did. So I'm going to go right into what we're really going to be talking about with the election in mind. But frankly, the election in this area is not as important as it was in Roth. So we're going to be talking about what I consider the best estate plan for married IRA and retirement plan owners. And we're also going to, this will apply even if you aren't married, but let's say that the people who will get the most out of this, even though the concepts are quite similar actually, will be people who are married. We're also going to be talking about, in effect, the cost of doing nothing. So it's not like, you'll do great if you get it right, and you'll just do okay if you get it wrong. If you get it wrong, it could be a huge, huge problem. And we'll talk about some of the details of what I believe is the most likely solution, which, as I mentioned in the first webinar, was actually peer-reviewed and approved, now known as Lange's Cascading Beneficiary Plan. Back in 1998, we've done thousands of these before I sold the law firm, of these documents, and it has worked out wonderfully. Now, not for the people who died, but for the survivors. And one of the things about being in business 40 years, and you meet people in their 60s and 70s, and you go through the aging process, and then we've had quite a few deaths, but it's of course, it's always sad. And I remember most of the earlier clients, and it's sad when they do die, but it's also a good feeling knowing that we put in the best plan, and then we and our successor firm are actually implementing the appropriate estate administration strategies. And we love to get people, help people get the most out of what they've got. We're going to talk about a relatively new strategy, something I rarely see, but something that can be a huge, huge benefit, called Who Gets What. I love talking about it, and more and more people are doing it. And when you hear it, it's going to seem so obvious. You're going to say, gee, why isn't everybody doing that? Instead of why is hardly anybody doing that? But we will be talking about that. We'll also be talking about what I call controlling from the grave. Well, actually, that's not an original phrase, but that's ultimately what it is. So we're going to be talking about trusts. and we'll put together let's say the whole package into what we believe is going to be the best plan. So anyway, I do want to tie the election in because, if the Democrats, instead of the Republicans who swept both the presidency, the House, and the Senate, let's say the Democrats had. Well, and the slide says everyone, it's not really everyone, but a lot of people assume that there would be tax increases, that we would have something similar to, that we would have the sunset of the Tax Cut and Jobs Act of 2017, and that taxes were going to go up in 2026, both income taxes and estate taxes. Well, with a Trump victory, excuse me, it suggests that it is unlikely, not impossible, that we are going to have significant new taxes, that the sunset provisions are likely going to be, if at all, recognized, but they will be deferred till 2019. And it is possible we're going to have even more tax cuts. I'm going to try to limit the scope of this workshop mainly to the people who I cater to, which tends not to be the ultra wealthy people, folks with $30, $40 million. There's lots of interesting techniques for those folks. That's not the kind of people who I typically work with to put people in let's say, a generalized bucket, if you will. I tend to work with people who they weren't necessarily born with a silver spoon, and they weren't necessarily entrepreneurs, because I don't work with a lot of business owners, unlike a lot of people in my industry. But they are people who tended to be smart, tended to go to college, got married relatively early, worked for a company. They were very prudent. They put money in their retirement plan. The money in their retirement plan was matched by their employer, but at the same time, raising kids, braces, car payments, mortgage payments, hard to accumulate money, except in their retirement plan. That money grew and grew and grew, and now it's often millions of dollars. So I work with a lot of those types of folks, which is different than the silver spoons, different than the entrepreneurs, different than the ultra wealthy. But that's who I'm going to really focus on for this workshop. I'm going to do it in the area of married, but many of the concepts will still apply. So anyway, and we're also going to talk a little bit about asset protection, but the solution will be revealed in the next hour. And I want to do the background of why it makes so much sense. And then we'll get into some of the more advanced techniques. And also why, by the way, this solution is so well revered in the literature, getting testimonials from all these, very, very smart, serious gurus who themselves have written many books and at the top. And I think Erica included some of their names in the introduction, but people who I really respect in the industry. We're also going to talk about trusts and some concepts and some applications. And of course, we are going to end up with the solution. We're also going to talk about some of the exceptions to the Secure Act. But I'm not going to go through the whole analysis, but I'll just say, fortunately, the exceptions of the surviving spouse, qualified charitable trusts, and beneficiary more than 10 years younger, and people with a disability will not have that massive income tax acceleration at death. So I want to talk about two different types of taxes, and it's actually two whole taxing universes, if you will. And the one is the one that we all know, which is income tax. That's when we file our 1040 every year, and it is taxed on the income that we have, whether it's interest, dividends, wages, capital gain, other forms of income. And that is something that we are very familiar with, that we do every year, et cetera. But there's also a different type of tax and a whole different tax system known as a state, and it's really more accurate to call it a transfer tax. Typically, the transfer tax is assessed at death, but it's better to think of it rather than an estate tax as a transfer, because it is a tax of somebody transferring their wealth or a portion of their wealth to somebody else. It could be while they're alive. Typically, it is at death. And by the way, there's a federal transfer tax, and some states, including Pennsylvania, have either an estate or, in Pennsylvania's case, an inheritance tax. So, what state you are, you live in and die in, and the residence of your children is relevant here. We're not going to go into that level of detail on this webinar, but the federal transfer tax or estate tax has an exemption. And if you were single, you would, and if you died in 2024, you would have a $13.61 million exemption. So that, to oversimplify, if you had a $13 million estate and you left it to your kids, there would not be a federal, and you didn't have any taxable gifts or credit consuming gifts, which I'll get into, there would be no transfer tax at your death. If you are married and you died in 2024, you could have $27 million before there is a transfer tax. By the way, the vast majority of you will not have a transfer tax problem, but you, almost all of you, have an income tax problem, because so many of us have IRAs and retirement plans that will be subject to income tax either during our lifetime or at our death. Now, the sunset of the Tax Cut and Jobs Act of 2017, remember it said, okay, we're going to cut taxes in 2017, but back in 2026, in order to balance the budget, we're going to reinstitute the high rates of 2017, and we're going to add inflation. Now, if we did that, you're talking about roughly, and this would sunset in 2026, it would be 7.5 million per taxpayer instead of 13.6, or 15 million for husband and wife instead of 27 million. But we don't think that with a Republican president, Congress, administration, and the environment, that is actually going to sunset. We actually think that the tax cut is going to continue, maybe even more tax cuts. So the way I'm looking at it is we have, this very, very substantial tax exemption. So most of us are not going to have to worry about the transfer tax, maybe at the state level, but not at the federal level, which tends to be a much higher percentage. Like in Pennsylvania, it's 4.5% for lineal heirs, unlimited for marital deduction. And, lots of different states have different levels of taxation at death or a transfer tax. But we think that the Tax Cut and Jobs Act of 2017 will not sunset, and it will be excluded. So before I get it, I'm going to take a little bit of time out from my original. I put this in last night at like 2 in the morning or something like that, because it's a really important question that most people get wrong, and it's a little bit tricky, which is why I hesitated to put it in. But I really want to give you great value during these workshops, and I think it's a critical question. So people say, oh, okay, well, for gifting, how much money are we allowed to gift? Well, let's say in 2014. Oh, okay, well, the number is $18,000. And if you are married, then it goes, and your spouse joins in the gift, which can be done either by writing a check from a joint account, or having a spouse sign something saying that they're joining in the gift. then it becomes $36,000 per donee for a husband and wife. And some people give money to their kid and then their kid's spouse, or their kid and a grandkid. So you can give away a fair amount of money. I'm using this, and basically that amount that you give, let's just keep it simple, $18,000 for one typically parent to one child. That's how much money you can give without eating into your once in a lifetime exclusion. But let's just say, for discussion's sake, that you listen to what I'm going to be talking about in the third session, which is it's a mistake to die with too much money. And I'm just going to take an extreme because I like to push boundaries a little bit. What if you wanted to give your kid $1,018,000? What would be the impact of a gift? Oh, Jim, I can't give more than $18,000. That's the limit, right? And boy, if I give them $1,018,000, then I exceeded the limit by $1 million. Well, that's true, but that doesn't mean you're going to be taxed on that. All that means is that $1 million is not subject. That is not subject to tax now. It reduces your once in a lifetime exclusion. Well, who cares if your lifetime exclusion is now 27 million, and you do have to file a gift tax return, but that's not a big deal. But who cares if you have $5 or $10 million and your exclusion goes from 27 million to 26 million? So a lot of times it does make sense to exceed that $18,000 per year gift. And in addition to Roth IRA conversions, gifting is one of the most powerful strategies, not only to reduce taxes, but also to get money to your kids while they are younger. So many of my clients, and a lot more without my intervention, but with my intervention, even still with my intervention, so many of my clients have limited their gifts to the $18,000, and their kids needed the money more when they were younger, but the parents wait, they accumulate, die. Then the kid gets a lot of money, maybe when they're in their 60s, well past the point when they could have best utilized that money, because the parent was limiting themselves to the 18,000. And I'm not saying to give your kid $1 million, but if it's appropriate to give your kid more than $18,000 a year, you can do that without running into taxes. In fact, it will often reduce taxes. If your kid's in a lower tax bracket, then the income on that gift is going to be taxed at your kid's rate, not your rate. You live in Pennsylvania, you're still reducing your Pennsylvania or other state that has a transfer tax. You're reducing that tax not only by the amount given, but by the growth. And let's just keep it simple. If you make a gift and you die 10 years later, and that money would have doubled, let's just say you made a gift of $1 million, then you're in effect getting both the $1 million and the additional $1 million growth out of your estate. A lot of times it makes sense to do gifts, and that's not part of what I would call the best estate plan. Actually, it is, but it's not something that I have talked about at length before. I'm being a little bit more generous with my clients' money these days, as I see, having done this for, I hate to say it, but 40 years, seeing too many die with too much money. And it doesn't make sense. That's going to be one of the mistakes that we talk about. So again, it gets money out of the estate, it gets the growth of the money, and it gets a kid's money when they need it, instead of a large inheritance tax subject to a large inheritance subject to a big tax when the money isn't really even that meaningful. So this is one of the things I say about gifts. What if someone gave you $100,000 right now? Right check. Happy birthday. Here's $100,000. Well, maybe Merry Christmas or Happy Hanukkah at this time of year. Here's $100,000. For most of you, would that really change your life? Would you go on an extra vacation? Would you buy a fancier car? Would you even go out to dinner? For a lot of people on this webinar, the answer is no. You wouldn't do anything differently. But what if somebody gave you $50,000 30 years ago? And with inflation, you can nitpick on this, but that's roughly what it is. What if somebody gave you $50,000 30 years ago? That might have made a big difference. And maybe now you're in the position that you can help your kids, and not by dying with a lot of money when your kids are in their 60s or even older, but by helping them out now. And I'm not saying make gifts that will jeopardize your own financial future, but most of the folks on this webinar, they could afford more than an $18,000 per year gift. Okay, so let's get back to our classic problem and what I think is now a classic solution. Again, because we've been doing this. I was doing this as an estate attorney in the mid-90s when hardly anybody was doing it. And it's not an original idea. I read about it. And I even called the author of the article who wrote it. And, I had some technical questions for him. And I remember he gave me a kind of a warning. He was kind of an old Southern guy. I said, son, if you're going to do this kind of disclaimer planning, you better know what to do when somebody dies. And he was absolutely right. So that's a hint of what is coming up. But I believe it is for most married couples, particularly traditional married couples, the best estate plan. And when you hear it, if you have not heard it already, and by the way, a lot of people have listened to some variation of this talk for years, and I believe it is very helpful. But the uncertainty of what is going to happen, and I would say the uncertainty of what is going to happen is exacerbated more than it's ever been. I think that we are in uncertain times. So one of the great uncertainties is how much money are you going to have? Larry's maybe going to help us out a little bit on some investment perspectives, but the truth is we don't know how much money we're going to have when the first of the husband and wife team die, and we don't know how much money is going to be there at the second death. What are some other things we don't know? We don't know what the law is going to be like when you die. Look at the difference in the law between December 31, 2019 and January 1, 2020. It was potentially millions of dollars difference by you doing nothing, just on the accident of dying one day earlier or one day later. Sometimes like George Steinbrenner to me, I hate the Yankees. He died in one of the few years there was no federal estate tax. Great timing because he didn't have to pay, his family didn't have to pay estate tax on his interest in the Yankees. Saved his, family, hundreds of millions of dollars. So, but if he had died, a year later, a year earlier, there would have been an enormous tax. So we don't know what the law is going to be like. We don't know how much money is going to be there. We don't know who's going to die first. A lot of times people, the husband who is typically older and us men don't live as long, so we say, okay, we assume that the husband's going to die first. Hey, guess what? That doesn't always work that way. And believe me, after 40 years, I've seen a lot of things that we didn't expect that would happen. A lot of times we don't know what the needs of the survivors are. Sometimes you have a kid who isn't doing too well and maybe dropped out of college and was on drugs, and you always thought that he was going to be or she was going to be the one that needed help. And it turned out they did great. And the other kid that we all thought was going to do really well didn't do so well. Or maybe there was a divorce in the family. Maybe there's a grandkid with a child with a disability, or who knows what's going to happen, not just with us, but with our kids. And these are great uncertainties. What are the tax rates going to be? I don't know. You know, they could have gone if the election went the other way, and if we're looking till 2026, the taxes would be radically different than they would because of the Republican sweep. So how can we predict what's going to happen when we don't know when we're going to die? We don't know what the tax rates are going to be. Where will you die? A lot of people assume that they're going to die where they're living now. Hey, guess what? Again, I'm working now with a lot of people who are older, and what's happening with a lot of them is they are moving to a state not based on because that's where they think it would be a really cool place to retire, but because that's where their kids end up. So I have more and more people going to states that they never thought that they would be a resident in. I have people, I have a client who said, the last place in the world that I want to live is in Florida. Guess what? She's in Florida. Why is she in Florida? Because that's where her kids are. Makes sense to me as she gets older. And it's good for the kids. It's good for her. I have somebody who one kid lives in the Northwest, one kid lives in the South, actually in Texas, and goes back and forth. And if I had said, gee, are you going to be a resident of the Northwest? Are you going to be a resident of Texas? They would have thought I was nuts. So we don't know where you're going to die. Where is your survivor going to live? And by the way, that makes a big difference in taxes, where the survivor is going to live. Are they going to live in Pennsylvania, where I am from, and still that is my primary residence and the residence of my business? Or are they going to, I have people doing the worst thing you can do, by the way, from income taxes is you work your career in Pennsylvania, and Pennsylvania doesn't give you a break on your retirement plan contributions. And then you move to California that taxes your retirement plan contributions when you take them out. At least Pennsylvania says, okay, we're not going to give you a break when you put the money in, but we're not going to tax it going out. Well, gee, the worst idea in the world from a tax perspective is working in Pennsylvania and retiring in California. Well, guess what a lot of my clients, or New York, guess what a lot of my clients have done exactly that. Why? Because that's where their kids moved. So we don't know where we're going to end up. We don't know necessarily. Some of us have a pretty good idea. But the other thing is we don't know where sometimes our kids are going to end up. Now, I have some people who moved out to be with their kids, and then their kids got a different job offer and they ended up going to a different state. And then the parents were, well, gee, do I have to move again? Some have, and frankly, some haven't. And the other thing about projections, we are big on math, and we love to do projections. And we do Roth projections and tax projections, and we do projections out the wazoo. And we've done thousands of them. And guess what? Every one was wrong. Maybe we came close, but there was always some assumption that we made that didn't exactly happen. So again, should you still do the projections? Absolutely. Are you way, way, way better off doing projections than guessing? Absolutely. But that said, something different than you think is going to happen is going to happen. It's not going to work exactly the way you predicted. So knowing we have all these uncertainties, rather than guessing wrong, what if we had a system where maybe some of these uncertainties wouldn't necessarily be as decisive in your estate plan? So again, I can't see people, but if I could ask for you to respond in the chat, and maybe Erica can tell us if it was live in the room, which I still like live better, but that's not as practical these days. Although I do them. I did a bunch when I was in Pittsburgh. But by a show of hands that will be shown in the chat, can I ask how many are married? That would be appreciated. And if you are married, if you were in person, I would say keep your hand up. But then I'm going to ask, do you have any children? All right. And then I'm going to ask, if you have children, are those children the same children as your spouse's children? So again, I call that the leave it to beaver marriage. Original husband, original wife, same kids. So I'm not talking about the love child from the 60s. I'm not talking about kids from her marriage or kids from his marriage and things like that. Interestingly, a lot of people say my child, and I mean, do you mean your child or both of your children? And then I sometimes get a dirty look by the surviving spouse, or not the surviving spouse, because at this point they're both kicking. But anyway, so I'm going to call that the traditional leave it to beaver marriage. And Eric, I'm going to ask you to give me control back because I've been doing the last couple of slides by memory. And there we go. Okay. So if you were to say, okay, let's say that you have this traditional, what I call leave it to beaver marriage, original husband, original spouse, same kids, same grandkids. Is it your general preference, without getting into the details right now, is it your general preference that for your estate plan that it would be number one, spouse, number two, kids, number three, grandkids? Is that the general idea? And I think that that's what most people would say. What do people typically come in and say? I don't think anybody in the history of the world came into their estate attorney and they said, I want my grandkids to be so stinking rich they never have to work a day in their life. That's just not, I don't know, maybe somebody said it somewhere. But that's not what I get. What I get is, first, make sure that we are both fine while we are both alive. That is number one. Number two, so we are protecting not only both of us, but after the first death, second goal, protect the surviving spouse. All right, we love our spouse. We want to make sure that our spouse is going to be financially secure, not only for the rest of both of our lives, but after the first spouse passes. Yes, of course, we want to cut taxes and leave the most to our children. But again, number one and number two is each other and then the survivor, and then leaving the most money to our kids, and obviously reducing taxes, and then providing for our grandchild. So does that sound like in general what people want to do? And I would actually say most people would say yes. What are some of the tax advantages? By the way, there's a tax-free, people call it a rollover. We actually prefer trustee to trustee transfer that goes from the deceased spouse to the surviving spouse. And we can have that minimum required distribution for the surviving spouse be much longer than if you leave the money to a child. There's no estate tax. There's an unlimited marital, both at the federal level, and every single state has an unlimited marital. So there's no estate or inheritance tax. The spouse gets the old favorable treatment because the surviving spouse is one of the exceptions to the Secure Act, meaning that they can stretch that inherited, well, it's not technically an inherited IRA because we're going to do the transfer. But anyway, we can use a much more favorable minimum required distribution rate than if we had the kids as the first beneficiary of the IRA. And in the case of a Roth, for the surviving spouse, there's no required minimum distribution for the Roth IRA, for the Roth 401k, the Roth 403b. So that money will grow income tax free for the rest of the spouse's life. We don't have that 10-year window. And then when the spouse dies, subject to exception, we get an extra 10 years. So we're really getting a lot of tax benefits by naming the surviving spouse. But sometimes there's advantages to having some money going to the kids at the first death. I'm not saying all the money, but some of the money. Maybe the adult child's in a lower income tax bracket than the surviving spouse, and the surviving spouse has enough money. So from a tax standpoint, it might make sense to have some money going to the kids at the first death. Maybe the kid or kids need the money now more than they need the money later. So we have a certain amount of money going to the kids at the first death. Sometimes we want to even skip the kids and have it go to the grandkids. Maybe the kids don't need the money right now. Maybe the kids have some creditors. Then we have the perpetual, ever-growing problem of the good son-in-law or daughter-in-law. We actually have a special trust that we'll talk about coming up just for that, called the I don't want my no good son-in-law to inherit 1 red cent of my money trust. But anyway, so what is the, so by the way, we have a name for that type of estate plan that I just talked about. And I call them, they're really not so simple because they have a bunch of thought out provisions, but I call them that the I love you will. Leave everything to you, you leave everything to me. Something happens to both of us, it goes to our kids equally. If something happens to one of our kids, then if they have kids, the kids of the surviving grandchildren of the child who died first, they get the money that the predeceased child would get, but obviously in some type of protected trust. All right. Now, by the way, a lot of estate attorneys even botch that, but that's what I would call your standard basic I love you will. And that's much, much better than nothing. Now, again, I'll tell you where a lot of people screw it up is in filling out the beneficiary designation of the IRA or the retirement plan. But that's another issue. But anyway, that is what the standard plan is. But we just said, hey, it might make sense for the kid to get some money at the first death. We said it might make sense for some of the money to go to the grandkids at the first death, even if their parent is alive. So how do we, and we're dealing with all this uncertainty that I had mentioned before. So what is the answer and the best solution to the Leave It to Beaver couple? And ready for the drum roll, here's the answer. Don't decide. You're not going to decide right now. Well, gee, Jim, how can I not decide? No, because right now you and your spouse are alive and you're drafting these documents. So what you're going to do is you're going to do a cascade, or what I'm kind of recommending, and there's different variations of it, but you're going to do what, and by the way, this goes by different names in the literature. Some people, if you go to the fancy peer-reviewed journals and the Wall Street Journal, which has featured this, they will call it the Cascading Beneficiary Plan, which, by the way, is trademarked under my name. But what I call it is Lange's Cascading Beneficiary Plan. So here's what we're going to do differently from that versus the, let's call it the I love you wills. Well, we're going to start this cascade from generation to generation to generation, first by naming the spouse, then by naming the kids, typically equally, then naming trusts for grandkids. So what's the difference between that and the I love you wills? We're going to put in a really important provision or concept called disclaimers. All right, now what is a disclaimer? You can't force somebody to accept a bequest. So dad dies, and let's just say he had a separate account for $100,000, and he left it to his spouse. And if there was a document for that 100,000, typically that's just one part of a much larger estate, but I'll just do it conceptually on this 100,000. I leave the $100,000 to my spouse, but if my spouse disclaims, then that $100,000 will be split between my children equally. So now we have a situation, and the spouse is not forced to take that money. She can always say, I disclaim. No one can force you to take a bequest. And she can't say, I disclaim it goes to Joe, I disclaim and it goes to kid number one, I disclaim it goes to the grandkids. No, all she can do is I accept, I disclaim, or I accept part of. What happens if she disclaims? Now we go back to the document that was originally prepared. What does the document say? I leave the $100,000 to my spouse, but if my spouse disclaims, then I leave it to the kids equally. In other words, it goes next in line. The surviving spouse has 9 months to make that decision of whether or how much or which assets to disclaim. So there's no rush. You don't have to come in 2 days after the death. In fact, I actually don't even want you to come in that early to the estate planning office because you're too wrapped up. It's too emotional. These are important decisions that can have a huge impact on the family and a lot of times there's major benefits of getting money to the surviving spouse to kids through disclaimers at the first death. So you have 9 months to decide this. So there's no particular hurry with this. So again, we can have the surviving spouse, the kids, and guess what? We're going to even put in provisions that a kid can disclaim to a grandchild. So let's say that, and by the way, this is even more relevant to the second death. Parent disclaims to child. Child says, hey, with one particular asset or this much of this asset, et cetera, I disclaim, and it goes into typically a trust particularly if the grandkid is young. It goes into a trust for the benefit of the grandchild. And guess what? Since the parent is still alive, they can be the trustee of the trust. Where with a traditional document, the way the grandkid is getting money is only if their parent predeceases them. So we're adding enormous flexibility to this plan. And we have been using disclaimers for years and years. And at the risk of getting too technical, we used to save people a ton of money by disclaiming IRA and retirement plan money to younger beneficiaries who had a much longer stretch than the surviving spouse. Now, the surviving spouse has a much longer stretch than the beneficiaries because the non-spouse beneficiaries are limited to a 10-year minimum required distribution period, where the spouse could stretch it much later. So now we're still using disclaimers, but we're typically disclaiming after-tax dollars. So if you had the disclaimer language in both your IRA beneficiary designation and your wills and your trust, you could have a much different plan without changing the language just by making a different decision within 9 months after death. And by the way, you're supposed to review your wills every 2 or 3 years. Guess what? That hardly ever happens. I always review wills and trusts. I still do. And, it says here, something happens to little Johnny and Uncle Sue and Aunt Frankel not Uncle Sue, Uncle Frank and Aunt Sue will be the guardian of little Johnny. How old's little Johnny? 47? People don't change their documents. If I get somebody's attention to the point that they're willing to do their documents, I want to be very, very flexible, and I want to significantly increase let's say, the time horizon of those documents. So if they forget about things or they just don't get around to having it reviewed, and I'm not saying you shouldn't do that either, I'll just say the adding the disclaimer provisions and keeping the disclaimer concepts in mind just significantly increases flexibility and decreases the needed frequency of changing your documents. And we've saved people just so much money over time. Again, we used to disclaim IRAs and retirement plan money, and we saved a ton of money in income taxes. Now we are typically having the spouse keep the IRAs and the retirement plans. And if we're disclaiming some money, it tends to be after tax dollars. So very, very cool ideas. Before I get into a couple stories of some of the disclaimers that we've done more recently, I thought I would ask Erica if we have any questions at this point.
We do have some questions, although I was having some trouble turning my audio back on. Sorry about that.
But all right.
Let's start, let's see, with oh, wow. Okay. Um, so there are several questions at the beginning about whether these are taped. Yes, they are, and we will be making the videos available once they are produced to registrants. Okay, so the first question here is from Lisa, and she says, is there an ideal amount or dollar range slash net worth to work with you and your firm?
Yes, there is. Unfortunately, we put so much time and effort into this, and I'll explain this a little bit more at the end. But our starting minimum is $2 million, although very frankly, we make exceptions. In fact, some woman on the first webinar said, "Oh, geez, I don't have that much money, but I really want to work with you guys. Will you make an exception?" And I'm not, it's not a hard and fast minimum, but there's so much work involved for us and the money manager that we just can't make sufficient money on, let's say, $1 million of assets under management, which was kind of our old minimum. But I don't want to say no to somebody who I think I can really help. So that's the long answer to the short question.
And I think maybe one other, just to make a long answer to a short question a little bit longer, one other thing that Jim might normally point out about sort of our ideal client is that it's someone or some family that has accumulated the majority of their assets in uh, their retirement plans, their 401ks, their IRAs, and their homes, not necessarily people who, for example, have like large rental real estate property businesses, like thing. So our strategies are really best suited for people who have significant funds in our IRAs and retirement plans, either pre-tax, post-tax, or both, right?
Or and Roth, yeah, but that's generally right. And it's not necessarily the majority, but a significant amount because you can do more planning that really makes a big difference when people do have IRAs in retirement. And yes, I'm not going to say I don't care about money because that's not true, but I also care about impact, and I very much want to impact families and make a difference in people's lives.
And I guess maybe just one other thing I would add after kind of observing Jim uh, interacting with our clients and the type of strategies that we often recommend. I might also say that we are often a good fit for families that have specific bequest. They have a desire for example, if they have one child who is doing super well financially and another child who maybe has a disability or isn't able to work, or even if they just want to, they have assets in all different locations, but they really want to evenly divide them between their children. Like our CPAs are really great at working with clients to develop sometimes complex but also very useful in achieving the goals of the client strategies for things like bequests in estate planning or even lifetime giving.
Erica's giving us a preview on who gets what, but go ahead.
Sorry, I didn't.
No, that's all right.
Okay. The next question comes from Colorado Ron, and he asks, once both spouses have died, how should your heirs retitle their inherited IRAs and Roth IRAs?
That's a really good question, Ron. And if you get this wrong, you could have a really bad result. What a lot of people used to do is they would just be simple. They would call it, Ron's IRA or IRA of Ron, or Ron's IRA from his dad, or they would just put Ron himself in terms of titling. And all kinds of bad things can happen if that account isn't titled right. And so many people botch it. Now, the IRS doesn't necessarily catch it every time. In fact, probably more times than not, they don't. But you never want to be vulnerable. And even if you have it in, you put it in the wrong name, and even if you change it later, the fact that you started it in the wrong name can still have the negative tax impact of a massive tax acceleration. So the way I'm going to recommend it is inherited IRA of, whatever Ron's dad's name is for the benefit of Ron. Oh, deceased, and then put in a date for the benefit of Ron. So we want the decedent's name in there, a little bit of immortality, by the way, because that name continues for the length of Ron's life. And we want to say inherited IRA, and we want to say the date of death, and we want to say who the beneficiary is. Typically, unless it's a trust, it might be for the benefit of Ron. And if Ron has a sister and she's getting the same thing, then I actually want that account separated at death, and one account would be inherited IRA of Ron's parent for the benefit deceased so-and-so for the benefit of Ron, and then for his sister, same thing, except instead of for the benefit of Ron, for the benefit of his sister. Great question that, and this was not a prepared one, but I would say that is often botched. Again, it's not often caught, but it's a real area of concern, which is one of the reasons why I don't like financial advisors filling out legal forms. I really don't. That's an attorney's job, and not only an attorney's job, but an attorney that knows what they're doing with IRAs. And I don't want to say anything bad about any attorney, but there's a lot to be. So I'll just leave it at that. Okay. So back to a couple stories. Facts are changed to preserve confidentiality. But in one situation, we have mom and dad who have, let's just keep it simple, a $3 million IRA and $3 million outside the IRA. So I just said before, for income tax purposes, it might make a lot more sense for mom to keep that IRA or Roth IRA because they get to stretch it longer. In the case of the Roth, they don't have to have any minimum required distributions until after they die. So let's assume, for discussion's sake, that the husband and wife had $6 million. And again, keep it simple, 3 million in the IRA and 3 million outside the IRA. And let's assume, for discussion's sake, that based on the lifestyle of the surviving spouse, that $3 million was more than that they were ever going to need. They were still spending $100,000, despite my pleading with them to spend more. So $3 million, with their life expectancy and even using all the conservative assumptions, let's assume that was more than enough money, even if it was IRA money, because they were still getting Social Security, the higher of the two Social Securities and some other things. So, but they had 3 kids, and they said, well, gee, does it make sense? And let's say, for discussion's sake, that the surviving spouse had a 10-year life expectancy. Does it really make sense to wait another 10 years for any of our kids to inherit any money when they're already in their 50s? And if they wait another 10 years, then they're not going to get the benefit of any of our money until they're in their 60s, maybe even later. So we said, okay, well, if 3 million in the IRA is more than enough, and it makes sense to give money to the kids at the first death, why don't we, because we did these disclaimer documents although technically you don't have to get the documents exactly right to do this, but that's another question for another day. But why don't we disclaim the after-tax dollars? All right. So dad dies, 3 million in the IRA is more than enough for mom. So mom disclaims the other $3 million to her kids, $1 million to each kid. All right. Each kid uses the money differently. One beefed up his retirement plan, made Roth conversions, funded college education, and spent some money and saved the rest. Totally reasonable plan. Another, they disclaimed a bunch of that money to trust for the grandkids. So they kind of ended up skipping a generation to provide for their children, the grandchildren of the predeceased investor or testator. And that was in that situation was a totally reasonable. And one bought a beach house. But guess what? All three of them enjoyed that money, not when they were in their 60s, but when they were in their 50s. And ultimately, mom did die, and then the rest of the money went to them, but they all benefited enormously, and it didn't make any difference to mom. Mom ended up dying with more than 3 million anyway. So we utilize the money so much better for the lifestyle of the kids. And we'll get into the issue of, yeah, you don't want to spoil your kids, but we're not talking about a spoiled brat who's 21 years old and doesn't have a work ethic. We're talking about kids in their 50s. And if they don't have a work ethic by now, it's not, I don't know if you're necessarily going to change anything by the time they are in their 50s. So we got a great result using the concept of disclaimer. We saved a lot of tax money, and more importantly, the children put it to good use. Without any disclaimers, all these benefits would have gone away. So this Lange's Cascading Beneficiary Plan, I would say it's a system. So I like to use it if you trust your spouse, and that's a whole other discussion. But if you trust your spouse, what about giving your spouse the option to disclaim IRA money, after-tax dollars, Roth IRA money, life insurance, house, everything. Give them the option, and that way that allows the spouse and hopefully the estate planner or even the family member to help them after the first death, and we get a much better result. And again, we've been doing these types of documents since '95, and we typically meet people maybe in their 60s or 70s. And frankly, after 40 years, a lot of these folks are no longer with us. So a lot of people have died with these plans in place. And again, there's been great benefits for the family. And yes, there's some variations with the new administration, but I think that this classic plan has held up beautifully. And again, we like to use it for wills and revocable trusts and IRAs and retirement plans and Roth IRAs and annuities and again, very flexible. In the old days, we disclaimed the IRA. These days, we're disclaiming after-tax dollars. Okay, before I go on, are there any questions on the Cascading Beneficiary Plan? Even if I run late, this plan is so cool, and I see it so rarely, except in the documents that we prepare. So I'm kind of pitching, even though we're not, by the way, we don't do legal services or formal legal services like drafting wills and trusts. So this is not a solicitation for that, but I love it so much, I keep talking about it. And frankly, I don't know how to say this nicely, but I want to get everything right. I want to get the investments right. I want to get the strategies right. I want to get the Roth right. I want to get the estate planning right, even if we don't draft the documents. So since this is so important, why don't I take one or two more questions, and then I will move on to some of the advanced topics.
Absolutely. Now, I'm not sure that these specific questions are necessarily specific to the disclaimer component, but it is about gifting to different members of your family, whether it's lifetime gifting or in your wills.
I
And the
love gifting questions. Very important. So go ahead.
okay, the first one is from an anonymous attendee. They ask, can I gift a chunk of my rollover IRA to my children while I'm alive and let them convert it to a Roth IRA and pay at a lower tax rate?
No. If you take money out of your IRA, it's taxable. Boom. Now, what they could do is take money out, pay the tax, and gift it to their kids. But if the idea is to get it to somebody in a lower tax rate, then you're taking money out at a high tax rate and you're gifting it to somebody at a low tax rate. Uh, that is one of the exceptions to the exception. First rule, pay taxes later. Exception, pay taxes later, except the Roth. And the third exception, or the next exception, is exactly what is suggested, although what they're trying to do is just wrong and bad and could get, and by the way, these things happen all the time. I have seen massive income tax acceleration that was never meant to be, and sometimes, very frankly, it wasn't the client's fault, or even if it was, I'm still going to blame the estate attorney, the financial advisor, the CPA, because to me, a good financial advisor, CPA, estate attorney, they're going to be proactive and they're not going to let their client do something stupid, like this, like what could potentially happen in this situation. But sometimes it does make sense to take some money out, pay the tax, gift it to a kid, have the kid invest it in something tax-free, like a Roth IRA or a 529 plan. But what the question is would not be cool at all. That would just be real bad.
Lockman asks, most of my large sums of money are in tax deferred IRA and Roth IRA. What is the best way to gift to children? Does it make sense to pay taxes and give gifts to the children? My after tax accounts have limited funds. Although he
Um,
did say he had a Roth IRA, but so
Well, and again, Jen would kill me if I said anything else other than you have to run the numbers for your own situation, but that doesn't really help. Here's what I said, that strategy that I just mentioned, where you cash in some money from your IRA, you pay the tax, you have the money left over from the after tax, and then you gift it to your kids. That might be a good solution. Something that is more aggressive that will probably make your stomach turn is getting a home equity loan, which is non-taxable, and then giving that money to your kids. And Dave Ramsey, would he would have a fit if he heard me say that. Yeah, that's a more sophisticated technique. We sometimes use that technique for Roth conversions too, but it is a problem. But here's the thing. I'm glad you're thinking about it because a lot of people say, oh no, I will never cash in my IRA if it's more than my required minimum distribution. I want to get that tax deferral, for as long as possible. And if taxes were the only issue, that might be accurate, but maybe it makes a lot more sense, even if it costs some tax dollars, to get the money to the kids earlier so you don't have that issue of accumulate, die, massive taxes. Kids inherit money in their 60s after they're too old to really get the maximum benefit from it. Okay, I'm afraid I'm going to have to move on. Let's see. Do I have about 20 minutes left? Is that right, Erica? Oh, no. I have 50 minutes left. Is that right? Um,
yes, this session goes until 2:30.
okay, good. Okay, I'm not way behind like like I have been known to be. Um, all right. So Erica actually kind of enunciated one of the things that we talk about on her own. She didn't put the name to it, but I will, and that is who gets what. And I've reviewed thousands of documents, and I rarely except for documents that we've prepared, see any estate attorney, including the fanciest, most expensive from, the uber wealthy firms that charge ridiculous amounts of money. I hardly ever see anybody do this. And to me, it makes so much sense. It's so obvious. And after you hear it, especially when I talk about money to charity, you're going to say, well, that's so obvious. Why isn't everybody doing that? But they're not. So, because I like to put catchy things to it, and I've never seen anybody call it this. I've actually hardly ever see it, but I'm going to take the call it, and maybe I should trademark it and call it who gets what. All right. So let's just say for discussion's sake, mom and dad, 2 kids, each have 2 grandkids. And most of them, even if they have the disclaimer documents, well, let's assume they don't have the disclaimer documents because the disclaimer documents might actually help you in this one. But let's just say that they have the I love you will. I leave everything to my spouse. If something happens to both of us, I leave everything to my kids equally. And if something happens to one of the kids, the money that would have gone to the predeceased kid goes into a trust for the grandkids. Okay. And the kids are treated equally. All right. Despite the fact that they might be in radically different financial positions. And then let's add charity in. And then I leave $100,000 to the XYZ charity. And typically you leave, it's a lot easier to be generous to charity at the second death than the first death. So you have the classic I love you will with $100,000 going to charity. All right. Now I want to introduce the concept of who gets what. Let's assume we have, let's look at our estate as a pie. Well, who's going to get money from our estate or our pie? Well, it's going to be surviving spouse going to get a chunk. Children who might be in potentially much different circumstances, they're going to get a chunk. Maybe grandkids, depending on the situation. Charity might get some money. And guess what? We have another piece of that pie is going to go to Uncle Sam. So the idea of who gets what is not necessarily changing the allocation between the surviving spouse, the children, the grandchildren, and charity. The goal of who gets what is to eliminate or at least radically reduce the amount going to Uncle Sam so everybody gets a bigger slice because Uncle Sam got a small slice or a smaller slice or none. All right, that would be very cool, right? To cut out or reduce Uncle Sam's share and let all the other beneficiaries, whether it's your spouse or your kids or your grandkids or your charity, have them get a bigger slice and Uncle Sam get a smaller slice. All right. I love that. Who gets what? How can we get a bigger slice for everyone else and a smaller slice for Uncle Sam? All right. So let's take the one that's the easiest and the most obvious, and what I hope will motivate a lot of you to make a change to your will, if not tomorrow, let's say within the next couple months. What did I just say for money going to charity? I had money going to the kid, the spouse, the kids, the grandkids, and $100,000 going to charity. And typically, that is what I see in people's wills. The money going to charity comes as a bequest that is satisfied either through the will or the revocable trust, and it tends to be with after-tax dollars, not IRA or retirement plan dollars. So let's just think about this very simplicity. In fact, I'm going to go slightly out of order, but I'm just going to finish the example of charity and then I'll get to others. In fact, maybe I'll skip ahead. All right. So remember, charity doesn't care about taxes. They don't care if they get a Roth IRA, a regular IRA, or after-tax dollars. But heirs should care a lot. Because if an heir gets $100,000 from as an inherited IRA, they're going to have to pay taxes on it. Yeah, they can stretch it for 10 years, or, you know, but they're going to have to pay taxes on it. But the charity doesn't care. So in this example, in the first example, we had the charity getting $100,000 of after-tax dollars, which means that the kids would get $100,000 less. What if we switch who gets what? So we're still going to leave $100,000 to the charity, but we're not going to do it in our will or our revocable trust using after-tax dollars. What we're going to do is we're going to take out the bequest of the $100,000 from the after-tax in the will or the trust, and we're going to put the $100,000 bequest as coming from the IRA. So now the charity doesn't care. They get $100,000. But instead of being out $100,000 of after-tax dollars, because the charity in the first example got the $100,000 of after-tax dollars, the kids are out $100,000 in an inherited IRA. But they would have to pay taxes on that inherited IRA. Let's forget about the 10 years and all that and keep it simple, 24%. So they are only out by $76,000. So just by making that little switch of who gets what, we just saved $26,000. And that's only on $100,000. What if it was a bigger bequest to charity? What if it was $1 million? That's a savings of $240,000 by just making this little switch of who gets what. And basically, that's a transfer from the IRS to your kids. Why isn't everybody? Now, if it's $5,000, $10,000, maybe it's not worth the paperwork and the aggravation, especially if you haven't done the documents and everything else is right. And you know, I don't want big fees for not much. But if we could save $24,000 or $240,000 by making a little switch, wow, that is really cool. Why isn't that standard? And by the way, I have been teaching this. You know, I used to give workshops for planned giving the planned giving portion of most of the large nonprofits, the universities, the hospitals, the museums, et cetera. They typically have they call it like a development department, which is basically trying to get gifts both while people are alive. I find it's much easier to be generous with charity at the second death than it is while you're alive or at the first death. But by switching who gets what and transferring the taxes, you know, let's say the tax savings to the kids at the expense of Uncle Sam, boy, that is a wonderful idea. Okay. The other thing is, what if your kids are not equally strong financially? So let's take an example where one kid is doing really well financially. They have a great job, they're making money, they're married to a spouse who's making money, everything is really good. And the other kid is struggling. And I'm not going to address the issue, should you still keep it 50-50? Maybe the answer is yes, maybe the answer is no. Most people's starting point is I want to treat my kids equally. And I'm not trying to change the purchasing power of how you're going to divide the pie up. What I want to do is I want to reduce the slice that Uncle Sam gets and then have a bigger slice for each of your kids. So let's just say, for discussion's sake, to keep it simple, there was a $1.4 million IRA and there was a $1 million Roth IRA. I'm using rounded numbers to make it easy. What if you leave the $1 million in the Roth IRA to the kid who's in the high tax bracket and they're doing well, and you leave the $1.4 million in the traditional IRA to the kid who isn't? Well, measured in purchasing power, that might be roughly equal, or maybe you can, you know, get even more specific and look at individual tax brackets, et cetera. But the idea is, if we left the traditional IRA to the kid in the higher bracket, then they're going to have to pay over 10 years taxes at not only their high rate, but then add, let's say, another, $1 million of income over 10 years at a very high rate. But instead, we're putting the tax burden to the kid in the lower tax bracket, but to compensate, we're giving them more money. And the Roth IRA is going to the kid in the high tax bracket, so they get an extra 10 years of tax-free growth. Again, the goal was not necessarily to provide more support for one kid than the other, although you might want to do that. Two, what I'm just talking about is by switching who gets what, we can be saving massive income taxes, sometimes hundreds of thousands of dollars. Again, am I going to complicate life for $5,000 or $10,000? Probably not. But if we can save 50,000, 100,000, 200,000, and it's basically at the expense of Uncle Sam for the benefit of your kids, very, very cool. I hardly see anybody do it. By the way, that's why sometimes it helps. The state attorney has a little bit of a math background. I've been fortunate to work with Matt Schwartz for many years, who has a math degree from Northwestern. I'm pretty quantitative, and I'm a chess player and a bridge player. And to me, it's fun doing that kind of stuff. It really is. I like that. To me, it's literally fun. It's a little bit, isn't that reassuring? Oh, this guy likes to play games with our money. But if I can save $100,000, $200,000, $500,000 in taxes, yes, that is a fun game. Okay. So, again, most of state attorneys botch this. They just get it wrong. You could say, well, it's not that they get it wrong, they do it the standard way, and we're, let's say, maximizing, but that's what I want for you. I want you to get maximum RIP. Okay, and I'm skipping over some slides, but oh, I'll tell you another one. Maybe it doesn't apply to that many people here, but what if you have a child with special needs or a child with a disability, like my own daughter? Well, if we leave IRA money or Roth IRA money to that child with a special need, that child, or to a trust with a child with a special need, that child or the trust can stretch that inherited IRA or inherited Roth IRA over their lifetime, or their sibling has to take it all out in 10 years. So again, maybe we want to have the IRA or the Roth IRA go to either the child or more likely a trust for the benefit of a child with a disability, and the after-tax dollars going to a child without a disability. And again, by switching who gets what, we are making a much bigger pie. And in that case, it might be a much, much bigger pie. And by the way, if you do have a kid with a disability, which is, let's say, my passion project, not at this point still a relatively small minority of the work that we do, some of these strategies make a huge difference, and the stakes are higher, because if you have a healthy kid and you botch the estate plan, well, maybe the kid gets a couple $100,000 less, but is it tragic? Well, yeah, it's not good, but presumably they could work and they'll be okay. Kid with a disability is not, and frankly, I even fear for kids with disabilities even more after the election. But by the way, if you do, this is a dedicated book, and we have two, in addition to me, we have two wonderful co-authors. So that the digital version of that is available as a bonus. If you want, by the way, and you have a child with a disability, maybe send us an email or something, and then I will send you a hard copy. It's not as relevant, and most of the information in there is in the Retire Secure for Professors and TIA participants, which, as Erica said, really applies to most everybody. Anyway, who gets what is very, very cool. Okay. All right, why don't we take a couple questions, and then I'll go into the next area, which is trusts.
Yes, just one moment while I figure out how to get my video back on. Okay, great. We do have a lot of questions. So the first one I'm going to ask is from William, and he asks, do you expect unlimited step up in basis to continue?
Very good question. So what he is talking about called the step up in basis. I buy a stock for $10,000. It goes up in value to $500,000. I sell that stock one day before I die. So what's my capital gain? $500,000 proceeds less $10,000 basis, capital gain of $490,000. Example number two, I buy a stock for $10,000. It goes up in value to $500,000. I die. In my will, I leave that stock to whoever I leave it to. Let's assume a child. That child now gets what's called a free step up in basis. Okay. So if they sold it the day after I died for 500,000, there is no capital gain for that child. All right, that's called the step up in basis. By the way, if you gifted that $10,000 stock the day before you died, and that child sold it either before you died or after, the child would have a $490,000 gain. But the question is, do I expect that, which is part of the current law, to continue? And the answer is, up until the election, I would have said, no, I expect that to be repealed. I still do. I don't know if it will be repealed before 2028. So I have a different answer than I would have had, even just a couple months ago. I still expect that it will be repealed. I knew that the death of this stretch IRA with the Secure Act was coming in one form or another. The government's going to need some money. And I don't know how to say it nicely, but it's easier to get money from dead people than alive people. So I think the step up is going to go away. Will it go away in the next 4 years under a Trump administration? My guess would be no, but maybe it will, because they're going to need some money from somewhere. And I don't think the tariffs are going to do it. Why don't I take one or two more?
Great. The next question is from Ron. He says, it sounded like Jim said that the date of death should be in the title of an inherited IRA. Is that true?
We're belt and suspenders. All right. I don't think that you necessarily have to put that date in, but we like to be really thorough. So we put it in, just because I think it's a better practice. And there's a difference, by the way, between best practices and what you can get away with. We're best practices people, so we put it in. I don't think that's a requirement though, but I like to be really clear, inherited IRA of Joe deceased for the benefit of Joe Jr. So that part isn't necessarily being a stickler. That's doing what I believe should be done. And again, are you necessarily going to get caught? I'll say more people have not got caught than have got caught. But if you're talking about $1 million IRA, man, you're talking about a massive income tax acceleration, because and sometimes I hate it when the financial advisor does this on their own without consulting the attorney, and they do it wrong. And then I just saw somebody advertising financial advisors do the estate plan yourself, and I'm like, oh my God. But anyway, you want to get this thing right. Don't try to save $5, or if you're a financial advisor, don't start practicing law unless you really know what you're doing. And even then, I don't like that. So anyway, why don't you go ahead? I'll take one more and then we'll move on.
We had a couple more I'm just going to sandwich together because they were both about disclaimers. So Richard asked, can the spouse still disclaim even if it's not explicitly written in the plan? And Jody asks, to use the concept of disclaimers, do you need to state it in the beneficiary designation of the assets, or does it need to be stated in the wills?
All right, so both, I'm going to say that they're both uh, more or less the same question. So the answer is you always have the right to disclaim without including the language. Other than the estates that our firm has been involved in, I have never seen a disclaimer without somebody having disclaimer language. And I've seen tons of disclaimers when there is a disclaimer language. So again, can you do it? Theoretically, yes. Does it often happen without the language? No. Again, this is a best practices situation. I want to see that language in there because I want to make sure that let's say that we have a lot of people who we did their wills and retirement plans and estate plans and beneficiary designations, etc. Then they move to another state and then they die, and some attorney is saying, oh, okay, gee, it says at first spouse's death, everything goes to surviving spouse. Okay, I'll transfer everything over there. All right, that happens all the time. Well, what happens if they're looking at the document and they say, well, it goes to the spouse unless the spouse disclaims? Then they have to think. Well, they don't have to think, they're attorneys, right? But they should be thinking, oh, what does that mean? Why did the attorney include that language? Well, maybe I better find out. So I like to have that language in there. Again, is it legally required or necessary in order to effectuate a disclaimer? No. But the other thing is, I like to be very explicit on if there is a disclaimer, who does that money go to? Does it go to the grandkids? Does it go to kid number one? Does it go to kid number two? Does it go to a trust? I want to, again, belt and suspenders to get this thing right, and particularly if you're talking about IRA assets. There's a lot of juice in terms of the difference between optimal and suboptimal, more so in the IRA world than in the after-tax world. So I'm just going to be advocating best practices, not saying it's absolutely essential to do this when it's not, but I didn't even want to bring up the issue of, well, what if it's not, but it was a question, it's a legitimate question. New topic, trusts. Well, a couple basic things. The trust can be created and funded during your lifetime. That's typically called a revocable or a living trust. And that is primarily a method of avoiding probate, which I don't want to spend too much time on. But we're seeing more and more people having, instead of traditional wills, we're seeing what are called revocable trust. You still do wills anyway. Typically, we do what's called a pour-over will, where it says I leave everything to the revocable trust, and that way, if you've been a little sloppy, you have a revocable trust, and again, I blame the estate attorney. You really should be transferring the assets to the revocable trust. Both the let's say the after-tax dollars, the brokerage account, often the house. So it's some work to do it. Why it costs a little bit more. Is it magical? No. Does it save taxes? No. It does save headache, and it does avoid probate. Typically, this trust is also called a testamentary trust because while you're alive, it's more or less the same as your money. You could do whatever you want. So if I take money in the Jim Lange account and I put it into the Jim Lange trust, the trust says Jim Lange can do whatever he wants with the money. Or it might be a joint revocable trust. So it's Jim and Cindy Lange, and while Jim and Cindy Lange are alive, they can do whatever they want with their money. But here's what happens at the first death. Here's what happens at the second death. And that's typically a revocable trust. You could have an irrevocable trust, which particularly after the higher estate tax exclusions, we're not such a fan of, and I'm probably not going to spend a lot of time on irrevocable trust. I will say they still have a place, but again, I'm only going to have time for so many issues. And then we have trusts that control from the grave. And there's lots of reasons that we will do that. Revocable trust, drafted and funded while you're alive. You and your spouse can be the trustee. Trust for minors, and these days it's more grandchildren than children, but it protects the child from themselves, protects the money against child creditors, protects the money from the other parents, which is a big one. That's the I don't want my no good son-in-law to inherit one red cent of my money trust. And then you could say how the money is used. Drug, sex, and rock and roll, maybe not. On the other hand, I find it interesting that Mick Jagger and Mitch McConnell are the same age. Maybe drugs, sex, and rock and roll isn't the worst thing in the world, but that's usually not what grandparents want for their grandkids. Typically, it's health, maintenance, education, support, and then maybe a third of 25, a third of 30, a third of 35. We always do that as contingent beneficiaries. And we give the kid the right to disclaim into a trust where they can still be the trustee. Okay, now I'm going to get a little woo-woo on you and talk about free judgers and free spirits. So we all have a little bit of both in us, but Carl Jung teaches us that most of us kind of have a preponderance of either judger or a free spirit. So judgers have a certain view of the world. And rather than them changing, they want the world to change for them. They like to plan. I will freely admit I am a judger. I have a certain idea of particularly money. You know, when people are young and even middle-aged, they're working and they should be putting money into their retirement plan. They should be maxing out their Roth IRAs. And at some point, a lot of clients should be making Roth IRA conversions, and they should have the Lange's Cascading Beneficiary plan as a will, and they should rethink it after the first death, and they should use some of the all the. So I have ideas of. I'm not going to want to change those things. I want people to do the stuff that I think is best for them. I am a judger. I like to plan, and I like to plan for other people. Well, then there's the free spirits. Well, the wind's blowing this way, I'll go that way. Jimmy Buffett, I go where the weather suits my clothes. I get it. Nothing wrong with it. It's all good. Well, are you guys judgers? Again, we all have some of each, but maybe show in the chat if you are, let's say, number one, a judger, number two, a free spirit. And I would bet that we're going to have a preponderance of judgers, because kind of people that attend these kinds of workshops, they tend to be judgers. The free spirits, they're at the mall. They're not attending this workshop. So let's assume that you are a judger. Well, it might be appropriate for you to have trust for even adult children, not just kids. Sometimes you're protecting that adult child from blowing their inheritance, blowing the tax planning, and ending up under a bridge. You're protecting the adult child from creditors. By the way, the most likely creditor is the future ex-spouse of your child. Again, I don't want my no good son-in-law to inherit one red cent of my money trust. What's some of the problems with trust? It does add some complications. If the underlying asset is an IRA, you have to really be careful with the drafting of that. There's 5 conditions. I won't even get into it all. There's an extra tax return. Am I going to do this to save $5,000 or $10,000, or even to protect $5,000 or $10,000? No. We might want different treatment for different siblings. And this is actually a true story. So when I had a radio, for 5 years, I had a radio show. I used to get wonderful guests. I had Jack Bogle on the show, all the top IRA experts. I actually read their books, developed intelligent questions, sent it to them in advance, and then we had this great conversation. By the way, it was wonderful education for me because I was able to, since people enjoyed, the people I tended to get, they liked deeper conversations rather than just a few simple questions and then the interview's over in 5 minutes. I actually did it for an hour. But anyway, one day I was reading the Wall Street Journal and it said, and they were correct in this, that if you want the trust to be a beneficiary when the underlying asset is an IRA, you really have to draft that trust with care. And most estate attorneys botch it. I thought, well, that's right. So they said, so instead of naming a trust, name an individual as the IRA with the IRA, and then name after-tax dollars for the trust, because if you botch it, you're not going to have an income tax debacle. I'm like, oh my God, that's such terrible advice. You want to maximize the situation, maximize everything that we can do to, particularly to protect that minor, protect that child with a disability, protect the child with the no good spouse. And it was really bad advice. The right advice is, hey, just get an estate attorney that knows what they're doing, so they're going to draft this thing right. And anyway, I'm furious and I write a letter to the Wall Street Journal. Dear Wall Street Journal, you said that when the underlying asset is an IRA that you shouldn't name a trust. That's the wrong advice. The right advice is when the underlying asset is an IRA, just make sure that you have an estate attorney that knows what they're doing, that has the 5 conditions, blah, blah, blah. Anyway, so I get the letter off. That very day, I had Bruce Steiner, who he's still around, by the way. I think he's a great guy. I still refer work to him. He's in his 70s. And he really gets IRAs and retirement plans. And he was one of the guests on the show. And I just kind of start the show. Hi, Bruce, how are you? I'm furious. Well, what's the matter, Bruce? He said, there was an article today in the Wall Street Journal, and it said when the underlying asset was an IRA, that you shouldn't name a trust as the beneficiary. You should name, a child or somebody that isn't a trust. And that was just terrible advice. The right advice is just make sure that you get an estate attorney that knows how to draft that document. I was so mad, I wrote a letter to the Wall Street Journal. And guess what? They didn't publish either of our letters, which were probably, at least conceptually, probably identical. But anyway, my point is, if you do want a trust as the beneficiary of an IRA, you better make sure that the estate attorney drafting that trust knows what they're doing. And in well more than half the cases, it used to be much higher, but in well more than half the cases, the estate attorney botches it. Again, I don't want my no good son-in-law to inherit 100% of my money trust. That's important when there's marital strife, undue influence, and you just don't trust your no good son-in-law or daughter-in-law. So we see a lot more of that. By the way, if you want to start a family fight, why don't you try to get your kids or your kid and their spouse to sign a post-nuptial agreement after they are married without a prenuptial agreement. Great way to start a family fight. I have done it, including one resulting in divorce. I contend they probably would have got divorced anyway, but me even bringing it up accelerated that process. I like bringing up the idea of a prenuptial agreement even before your kid has a boyfriend or girlfriend, because let's say, your daughter brings home, the guy with the tattoos all over their face and the nose rings and the earring, and says, guess what, Johnny just proposed. And then you bring up the issue of a prenuptial agreement. They're necessarily going to think, oh, well, that's because of Johnny, not because of the concept. But let's say you bring it up before they even meet Johnny, and then they meet Johnny. that's a much, much different dynamic. So I like bringing that up early. I actually have one guy, his kids were 18 years old, and as he's saying goodbye as they're flying off to college, he says, "Oh, let me tell you about prenuptials. Let me tell you about prenuptials." You don't necessarily have to do it that early, but that is one of the interesting ideas. And by the way, feel free to make me the bad guy. All right, I like to take the heat. Oh dear, this wasn't our idea. This was the estate attorney, CPA, financial planner's idea. He said it's really a good idea to make sure that we protect you. And one of the ways to do that is a prenuptial agreement. So when you meet the guy, or if the guy's already met, which is worse, they understand, and it's not you bringing it up, it's me bringing it up. I'm the bad guy. Okay, so we actually unfortunately don't have more time for questions. So why don't I start doing a little bit of a summary of some of the things that we talked about. And we talked about, well, the likely extension of the higher estate tax bracket. We talked about gifting, and gifting more than the $18,000 per year per beneficiary, which I think is very cool. We talked about the best estate plan for most married couples. We talked about who gets what, which I think is very cool. And we saved people a lot of money with that. And again, particularly with charity, it's easy and it's obvious. We talked a little bit about trust planning, which again, I think is important. We bedrock principle, pay taxes later, except for the Roth. There's so many things we didn't talk about. I'll put in one thing that if we had more time, I would have talked about it. I love multi-generation planning. I love if I have a client maybe in their 60s or 70s, or even younger, and they have a surviving parent, and I have the opportunity to make changes in the surviving parent's estate, which is so cool. I actually just did it in my own family. My father-in-law is 100 years old, and he still has an IRA. And since I have a child with a disability who could stretch that inherited IRA over their lifetime, so and also she is in a lower tax bracket than my wife and me, it makes more sense to have his IRA go to his granddaughter rather than his daughter. And I was able, and he still bright and gets it. I was able to have input into his estate plan. So instead of the inherited IRA being stretched over 10 years and then fully taxed in 10 years, it can go for the life of our daughter, who, because she has a disability, can stretch it out over her life, which might be, I don't know, 60 years. And the difference, again, it's life changing. Paying taxes later over 60 years at a low tax rate compared to paying it in 10 years over a high tax rate. And I was able to do it because I had some input into his documents. I didn't mention that, but I just thought I would throw that out there.
Allow me to ask you some important questions. Do you want to protect yourself and your family from massive income tax acceleration? Are you at least slightly concerned that future income and other tax increases will unnecessarily decimate your hard-earned savings and threaten the financial legacy you plan to pass on to your children and grandchildren? Are you willing to take action and defend yourself from government confiscation of your hard-earned money? Are you ready to take proactive steps that could help you and your heirs get the most out of what you've got? If you answered yes, this short video could be the most important thing you have ever watched. Imagine you could wave a magic wand and have a rock-solid financial master plan that has all your financial affairs in order. Think about how you would feel if you never had to worry about money because you had solid data that allowed you to make informed financial decisions, not guesses. How much better would you sleep at night knowing your financial master plan is in place? I'm going to share with you how you can make that happen. But first, let's talk about why it's so crucial to develop and implement your holistic, long-term retirement and estate plan. First, thanks to the sunsetting of the rates set by the Tax Cuts and Jobs Act, it's likely that your current income taxes will go up in 2026. But even if legislation is passed to enshrine the current rates before they expire, raising income tax rates isn't the only way to raise taxes. Jim Lange predicted the death of the stretch IRA and advocated defenses against it more than 5 years before the Secure Act became law. Jim had the foresight that almost no other retirement and estate planning experts did. He understood that the end of the preferential tax treatment of inherited IRAs and retirement plans wasn't a matter of if, it was a matter of when. Now Jim predicts higher capital gains tax rates, changes to federal tax exemptions, elimination of step-up in basis rules, and estate tax increases. Congress pulled a bait and switch on you, and it was just plain wrong. You were promised that contributions to your IRAs and retirement plans would pass to your heirs with significant tax advantages. Remember the stretch IRA? Because you were fiscally responsible, you acted on that promise. You sacrificed so you could put as much money as you could into your retirement plans. Then, late in the game, Congress pulled the rug out from under you by passing the Secure Act. The consequence of Congress's actions with the Secure Act? A massive income tax acceleration on money you thought was protected. But there is a way for you to fight back and protect your wealth from the Congress's greedy hands. We can offer you the means and the tools to pull back some of that money. There is no single strategy that will solve all these problems and ensure your future financial security. Nor is there a one-size-fits-all combination of strategies that is right for everyone. But Jim and his team will help you find the right combination for you and your family. Here are just a few of the strategies in Jim's arsenal. A series of timely Roth IRA conversions to be executed over a number of years. Social Security optimization. Lifetime safe spending analysis. Spend the right money first analysis. Appropriate asset location analysis. Estate plan evaluation. Lifetime and testamentary gifting strategy, including leveraging lifetime gifts to children and grandchildren, and our tax-savvy Who Gets What estate planning analysis. And all of these will be adapted to your unique situation and calibrated to provide the best results for you and your family. The choice to develop your financial master plan is not a choice to maintain the status quo. It's a proactive choice to improve upon the status quo and secure the future you dream of for yourself and your family. When you meet with Jim, he may propose implementing the superbly flexible Lange's Cascading Beneficiary plan. Its flexibility protects your spouse, allows for the possibility of directing money to your children after the first death, and allows for the possibility of directing money to your grandchildren with parents as trustees. These options are not available with traditional planning. Lange's Cascading Beneficiary Plan is really an estate planning system that should be considered for virtually all of your assets. It works for wills and revocable trusts, IRAs and retirement plans, Roth IRAs, and Lange's Cascading Beneficiary Plan is only one tool in Jim's arsenal. The first step toward peace of mind and a good night's sleep is to request a Retire Secure consultation with Jim Lange. During your 1-hour private Zoom consultation with Jim and one of his number-crunching CPAs, you'll discover how to cut your taxes and preserve your wealth. Jim will answer all your questions and concerns and likely suggest 2 or more tax-reducing strategies you had not thought about. Jim takes a multidisciplinary approach to securing your retirement. He accounts for taxes, legal, and investments. Jim has given thousands of consultations over the years and has never had anyone say or even imply that it wasn't worth their time. Why? Because Jim delivers real-world value and not a sales pitch. At the end of your Retire Secure consultation, you will have the outline for a concrete plan of action to maximize your retirement prosperity and generational wealth. Then you will have 3 options. You will thank Jim for his time and valuable recommendations and most likely end up doing nothing. You'll want Jim and his team to run full retirement and estate planning projections, producing your personalized financial master plan for a one-time investment of between $12,500 and $22,500, depending on the complexity of your situation. Or you'll want your personal financial master plan, and you'll want Jim's team to help you implement the plan, and have one of Jim's strategic partners manage at least a portion of your assets. If you select option 3, your personal financial master plan is included for free, and your personal financial master plan will be updated every year at no additional cost, provided you place a minimum of $2 million under management. A no-obligation Retire Secure consultation will likely provide you with at least one idea worth 10 or even hundreds of thousands of dollars. You can get it now for free, without obligation. The purpose of the Retire Secure consultation isn't to sell you. It is to determine if you are the right fit to work with Jim and his team. Please note that Jim will not take you on as a client unless he thinks he can save you and your family many times his fee. Jim only has a limited number of slots available for the free Retire Secure consultation before there is a waiting list. Since Jim personally conducts each consultation, and there are hundreds of attendees on this virtual event, Jim will almost certainly not have enough available appointments to meet demand. In addition, Jim's team will likely not have sufficient time to meet demand for financial master plan development. Developing each financial master plan is a time and labor-intensive process, and with ongoing obligations to existing clients, Jim and his CPAs only have so much capacity to take on new clients. So, to secure your free Retire Secure consultation with Jim Lange, click the offer link and complete the appointment request form now. Listen, with the uncertainty in the country, it's natural to be concerned about your financial future. But with proper planning, you can protect yourself and your family from massive taxation, get the most out of what you've got, and maximize retirement prosperity and generational wealth. And the first step is simple and free. Click on the offer link and request your Retire Secure consultation with Jim Lange. Don't wait and be disappointed. A happier, less stressful, and more abundant life awaits. Take action to secure your family's financial future now. Request your free Retire Secure consultation by clicking on the offer link.